Southeast Radio's Business Matters with Karl Fitzpatrick.
Southeast Radio.
Good morning, I'm Karl Fitzpatrick and welcome to Business Matters. Well, last week it was announced that Capital Flow, in conjunction with the Strategic Banking Corporation of Ireland, would be making a €50 million fund available for Irish SMEs. John Mackey, Head of Asset-Based Lending with Capital Flow, joins us now to tell us more about the lending market in Ireland at present. John, we'll be discussing your role with Capital Flow, but when you last joined me on Business Matters, you were working for Bibby Financial Services. So what triggered the move to Capital Flow?
Yeah, I moved from Bibby in November 2017. I took up the role as the head of sales for the asset-based lending division in Capital Flow. I think it was just for myself. I'd been 5 years in Bibby. I fancied a change. The opportunity came up. The plans were for a much bigger organisation with more products, greater portfolio of products that was on offer. So it was a good timing and a good opportunity.
Now, of course, Capital Flow doesn't have a high street presence, so many of our listeners won't be familiar with the company. So provide us with a background to it.
Yeah, Capital Flow was set up in 2016 by Ronan Horgan. He's the current CEO of the business. It was set up initially with a view to providing invoice discounting, asset-based lending and asset finance facilities to the SME market. It was set up with a view that it was felt at the time that there was a demand for just a flexible funder in the market. Around the same time I started myself, took on some guys to set up a property lending division, commercial real estate. So that's our suite of products at the moment.
I know from speaking to lots of business people, there are more and more frustrations with dealing with financial services organisations, one of which is bureaucracy. And something that's a real bone of contention for business people is that they're not always told about the full gambit of paperwork that they have to complete at the very beginning of the process.
Yeah, I think that's twofold. I think there's two reasons behind that. And the first one is probably to do with credit committees within banks, that when the lender brings a case to the committee, they look for more information, so the lender has to go back. And the length of time that sometimes it takes for these decisions to be got or whatever, the information that the prospect would have provided day one is out of date, so you have to go back looking for more, and there's additional information. And I think that's an issue that lenders in the bigger organisations where there is bureaucratic and there's steps and layers, that it's difficult to speak to decision makers. With ourselves, what we can do is we're open floor. We have access to our head of credit, to underwriters, that when we have a case that we're looking at, we can speak to the actual decision makers, the guys that are underwriting the deals. We can speak to them the day we look at an opportunity. So we know exactly what the pressure points are going to be, what the issues may arise. We don't have to wait till we actually get to a credit committee meeting to address those issues. So I suppose that allows us to be able to gather all the information that we need initially. I think the second thing then probably comes down to just experience of the lenders. We make a point of not going down that route of going back looking for more, this kind of, even this the thing of the slow no, or the slow yes. It's either we can do it or we can't do it.
When you talk about speed of decision making, of course, it's crucial for any SME. I can think of lots of companies in construction that would win a contract and they need to start almost immediately, but they may need particular specialist equipment, cranes, diggers, whatever it may be, to be able to deliver on that contract. But trying to get a decision on whether they can finance those pieces of equipment or not can often be quite difficult.
Yeah, if you're looking at that, it would specifically say buying equipment on the asset finance side of it. We have underwriters that have discretion up to $500,000. So that would cover the majority of what we would be doing on one-off assets, and that decision can be made within a day.
I know that Capital Flow had some exciting news regarding the Strategic Banking Corporation of Ireland last week.
It was something that we'd been working on for the last year or more. We SBCI, we had an announcement that they've given us 50 million. A 50 million facility to provide asset finance facilities to the SME sector.
So what does that mean for you as a company?
It's an additional fund there that we can lend. It's at a lower margin.
You're buying cheaper money.
It's cheaper money. Well, that's what the function of the SBCI is to provide lower cost funding to the SMEs using finance providers like ourselves as facilitators for that. They don't provide it themselves, so it comes through ourselves. So what we do is we'll pass on the discount that we receive from the SBCI directly on to the clients.
And what does that equate to, John?
Well, it equates to about 1%.
And in terms of the scope of this finance, will it extend to cover pre-owned vehicles?
Yes, the pre-owned vehicle side would be, and the pre-owned equipment, whether the machines or whatever it is, would be the majority of the type of assets that we will be financing. So it would definitely extend to that.
So when you're assessing a risk, what's your criteria for doing so?
Yeah, I think when you're lending against an asset, whatever that asset is, whether it's property or whether it's a bus or whether it's a truck or a kit or whatever it is, you look at the value of the asset, you look at the resaleability of the asset. So that's the quality, first of all, of the asset, and secondly, then you will look at the repayment capacity of the clients.
And how carefully do you scrutinise the history of the business and, of course, the borrower?
First of all, we're not. I'm not going to tell you that we don't look at balance sheets. We don't look at historical information. Everyone does. It's part of analysing. But where we tend to say our focus is on where the business is now and where is it going. Right? How is it performing, and what is the plan? What's the story? The actual individuals, the people that are there working in the business. We say we back the people. There's I'd say it could be 50% of the people that we're dealing with have scars dating back to the financial the crash. Like, you know what I mean? That is something that I think if we decided to make a policy that if a guy has a judgment against his name, if a company has been through examinership, if a director of a company has had a previous company that's been through liquidation, we wouldn't have done half the business we've done in the last 3.5 years. We're once we're satisfied with the credibility of the people working in the business, the people that own the business, and we'll do that by getting down, sitting in front of them and having a talk to them, kicking the tires, go down and see what their business is all about. That's what we're interested in, what we're interested in, where the business is now and where is it going.
An emerging trend that I see as well here in Ireland is business owners now using different lenders for different facilities.
Well, definitely. There's a lot of niche providers in the market now, whether that's invoice discounting, whether it's leasing, whether it's supplier finance, property finance, and even within property there's development finance, there's investment, and property investment finance. There's multitude, and I think that in Ireland we're still way behind the curve in terms of the split between the banks, the traditional banks, and the alternative providers. We're still around 80-20 in terms of banks, whereas you go to the States and there's a complete flip of that. 20% of lending in the States is done by traditional banks, 80% is by alternative.
You've provided almost €300 million worth of leasing to Irish businesses since the middle of 2016. What are you hearing from people out there in terms of why they're deciding to use alternative lenders?
I think, first of all, it's about certainty, knowing that, if they want finance for a truck, if they're looking at buying a truck, they know they can get it. They know they can call John Mackey or they can call whoever it is across the country, and they know they can get that. So it's certainty of knowing that they can get the finance for it. It's knowing that, the experience that they've had with us over the last 3 years, they know that these guys, they will deliver. They'll do what they say they're going to do. They know what information they have to give us. They know, the amount of the time that it's going to take to do it. What we were talking about earlier, the flexibility, the accessibility. If there's something wrong, they know they can pick up the phone to us and call at any time. I think that's what companies and SMEs are looking for now at the moment. And it's not all about price. I think it's about service. Now, they're not going to pay. You have to remain competitive. But the first thing when we talk to our clients, it's not about what's this going to cost me. It's about, here's what I'm looking for. Can you do it?
Another emerging trend that I see in the finance world is risk-based pricing of finance. So instead of you as a lender having a standard rate, instead you're assessing the risk. Is that something that we're going to see all finance providers do over the coming years?
I think it depends on what their strategy is in terms of what way they want to do their lending. If you're going to kind of go, well, look, as I was saying at the start, there's some providers who go, this is our product. This is what we do. This is who we want to do business on. And if you don't fit that box, they're not going to lend. Now, it's easy if you're doing that, so you're pretty much lending to the same client constantly. You can come out and say, this is our rate and this is what we want to lend at, and you can price it that way. with ourselves, where we're more specialist providers of the products that we spoke about, the risk can vary greatly from one deal to the next. So it's not realistic, and it doesn't make good business sense to price the two of those. If you have a high risk and a low risk deal, it doesn't make sense to price them the same. What we do as a business, you will look to obviously get a blended price at a level that we require to make our business viable. But in terms of, we definitely look at it's a risk-based approach to managing facilities and initially pricing them.
And finally, John, describe your sweet spot client to us in terms of the sectors they operate in, the turnover of their business, and then thirdly, how long they've been in business.
In terms of the sectors, on the leasing side of it, when we're talking about the SPCI today, like you're talking about, the haulage, the plant hire, that's the printing kind of sector, that's the machines, that's your kind of big chunk of what we do. On the invoice discounting side of it, it's non-sector specific, and on the property then it's anything, property from 250 up to 5-6 million.
Well, if you've just tuned in, that was John Mackey from Capital Flow, and I would like to thank John for joining us in the studio this morning.
Southeast Radio's Business Matters with Karl Fitzpatrick.
South